Let's talk technical operations here. The open market desk. Is the Fed's new regime going to work? We haven't talked too much about the reverse repo operations. Uncapped could be $2 trillion a day, the Fed says, $30 billion per counterparty. Are you going to be borrowing securities from the New York Fed?
Well, I think, lots of money market funds may be. There's certainly going to be a demand at that higher level. But Mike, that's a critical question. Can the Fed, raise the lower bound to 25 basis points or more? They've got the upper bound now at 50 basis points, reflective of the interest rate that they subsidize banks with at 50 basis points. But can they, in effect, on a transaction basis, hundreds of billions of dollars, can they make the lower bound work at 25 basis points or higher? We're going to see that starting tomorrow, but I think it's a critical question, because if they can't, then there are dislocations in money market flows and money market systems, and of course it would be reflective of a central bank being unable to raise interest rates to a level that they perhaps want to go.
Well, the short term, we have to wait and see how this all plays out. But across the rest of the curve, across the rest of fixed income, is there a pocket that is going to be troubled here, that doesn't get it, that isn't going to go along with the Fed?
Well, going along with the Fed is dependent upon how quickly they go. My opinion is that 2% in terms of an ultimate target for Fed funds is the maximum level. The green dots basically suggest 3.5%, and that's the dislocation between the market and where the Fed thinks neutral interest rates are going. I don't think they're going there, but for the moment, in terms of the minute-to-minute transactions, the market's selling off.
Bill, I spoke yesterday to Lawrence Summers. We had a fascinating conversation on his secular stagnation. We're hearing some of that from you right now. It is absolutely critical, Bill, within our time of disinflation of real yields, that 2% level. Are you predicting within the financial repression you have spoken so eloquently of, that the new 2% will be 1.8 or 1.6%? Is that Larry's secular stagnation?
Well, it is reflective of what Summers is talking about, what I've talked about for a long time in terms of, structural factors that Janet Yellen tends to dismiss. We have a high amount of leverage globally and in the United States, Tom. We have a demographic situation in which the boomers are aging and will save more and buy less. Well, we have a productivity problem, which Janet Yellen mentioned, at least in the press conference, that, is lower, perhaps because of technology and influences on the labor market. And so, structural influences, to my way of thinking, to Summers' way of thinking, basically cap the neutral Fed funds rate at 2% or lower. And certainly, getting there, to my way of thinking, takes a relatively long period of time. To Janet Yellen's way of thinking, perhaps because of short lags in monetary policy, only takes 12 to 18 months.
Right. Mike, jump in here with Bill Gross. To me, the key thing here is the effect here on the real economy going forward. Today's been a day of money markets and monetary policy. Where are we going to be on the real economy 6 months out or 1 year out?
Well, 1 year, we don't know. 6 months out, Bill, it looks like what she's saying is not much different. Things are going to get a little bit better. We're going to see a little bit more inflation, but a very small rate increase like this isn't going to do much of anything to the economy.
Well, I don't think it does, but to the extent that the path going forward is anticipated to be, much higher than what I'm suggesting at 2%, then that has to create some damage. It creates damage in terms of the housing market and the mortgage rate. It creates damage in terms of investment in the real economy, and ultimately it creates damage in the financial markets, because financial markets are dependent upon that short rate in terms of leverage and borrowing. That ultimately affects the real economy. So, of course it does.
Bill, what is the exogenous shock that we need to watch? You mentioned Japan. We've all been thunderstruck by the decline in commodities. There is China, and on and on. What is that exogenous shock that William Gross is paying attention to?
Well, the shock is a combination of factors, Tom. You can't suggest it's any one. You mentioned a number of them in terms of, the Chinese currency rate, which continues to depreciate, not by much, but, on a significant trend. You mentioned not only oil, but commodity prices, leverage, all of that in combination, suggests a global financial system that is sensitive, more than sensitive, to a number of shocks that basically de-lever the system on an ongoing basis. And aside from what's happening in the stock market today, basically the system itself is at risk in terms of de-levering because, they're positioned for 2 to 3% growth in the United States. They're positioned for a recovery in Euroland. They're not necessarily positioned for
Right.
negative effects in terms of emerging markets, Brazil, Argentina, what may happen in Puerto Rico. These are shocks that potentially lie ahead and could affect the real economy.